Good morning. This is Ken Long from Tortoise Capital with part two in our discussion of the Bollinger Band River framework. In part one, we took a look at the conceptual basis for the Bollinger Band River using this set of notes. So refer to explanation one if you need to review that discussion. And so now what I want to do is really just apply the ideas to the chart, show you how we get started with it. So this is the default setting I have on my machine for free stock charts. I'm not going to need the volume because I'm going to add volume at price on the left hand side when we get there. I like to show the open and the close line of the day all the time, and I like to use open, high, low, close bars. I like using white on the background. I have a harder time seeing colors on a black screen. The white screen looks like footprints in the snow for me, so I prefer that. And all of these other factors are normal. Nice thing on free stock charts is you can adjust your scaling in here, so if you need to see more or less of the relative scale, you can do that. It's handy for making markups, where if you want to adjust your frame of reference, as well as adjusting your time scale. The sliding scale is a nice way to forward trade ideas using the vision of the chart at the time, using the hard right edge. This is where having more screen real estate can help you. Alright, so I'm going to go to the daily. I'm going to clean. Actually, I'm not going to clean the screen. This is a live screenshot of a couple of swing trades we have going on currently in diamonds. I don't want to lose my framework. But I do want to show you how on a live trade that framework actually helps us make some judgments. Now, the blue line for us is always the date that we're stalking. Entries, initial stops, or going short, and then price targets on the way. So we have a couple trades already in on this one. So we're going to build the frame of reference now. We'll start with the basic river, and I'm going to add an indicator, a Bollinger Band. Bollinger Band width. Adding a Bollinger Band on price history. Nice thing on free stock charts, you can put indicators on indicators, and so I selected that I wanted it on price, but you can put it on other things. We're going to select a darkish blue. Oops, wrong one. I got to come up here and edit the indicator. So the plot color is going to be a light blue. Shading will also be a light blue. The line style, I'm going to make that solid. The width, I want it to be thick. Maybe that's too thick. So what that gives me is a nice lightly shaded region, but a strict boundary. If we want this to be 30 and 1. So that gives us the river. If we plot the center line, that's going to, it will show up as the default setting, but I'm going to make the Bollinger Band mean, which is a simple 30 period moving average. I want to make that red, so I'm not going to show that on this one. So that gives us the river. You can see trending price on this side of the river, came back for a drink, made his dash to the far side. Now he's out of the river and moving northward. So that's We see the herd behavior on one side, then the other. Now we're going to add the floodplain. On price. We're going to edit that. We're going to make that plot color also dark. We're going to pick that lighter shade of blue. Needed to make that 30, sorry. So now we have the river and the floodplain. So this is plus or minus 1 standard deviation. This is plus or minus 2 standard deviations. You can see the pinch. Now we're going to add a simple moving average on price. Excuse me. And we're gonna make that red and thick. So that gives us that clear demarcation of the Bollinger Band mean. Now I'm going to add the outer band, also thick red. That gives me the Z3. So this is Z0, Z plus 1 plus 2, minus 1 minus 2. So that gives us the Z3 boundaries, and that's going to contain 99.5% of the price data of the 30-period lookback. What I'm doing here is moving this so that I can see the Z3 boundaries. I like seeing the Z3s on my chart for ready reference. In my area of action. Now, I want you to notice the slope of the river is the health of the market. The Bollinger Band pinch is what we would call this collapsing. So we have expanding volatility here, then collapsing volatility to the tightest range, the pinch, and then an expansion. Now we're going to add the dragon. And that's going to be a Bollinger Band on price. And we're going to make him orange. And a lighter shade of orange. Give him a 10-period look back and a 0.5. Now I've been experimenting with plotting that center line to give us three markers, so that when price, which we mark off as the 10-period regression line as the smooth price, but I like to see, when I see price coming past this, I see 1, 2, 3 thresholds. So with a plus or minus half, this actually works out to a 10-period full standard deviation, a full standard deviation of the 10-period look back. And that gives me, I feel like a noise boundary on price. So when this breached the dragon the second time and takes off, you'll notice that the price never comes back through the dragon during all that peak, during all that trending behavior. The dragon was riding the edge of the river, came out of the river here, partially, fully out of the dragon. Very hard for the dragon to maintain this level of being out of the water. It's a big, heavy body. It wants to get back in the river, and so the price action brings him back into the river, and then he swims from one side of the river, typically, to the other. And now he's during this nice positive trend. It's normal to see the dragon on that side of the river and just steaming along. And then this becomes a reasonable stop point. We're going to add the parabolic stop and reverse. And I like point 2 and point 2, and I like showing that as black dots. This turns out to be a very tight stop when it's trending, and there's no magic formula to that other than just what I like to do in stock charts when I was trying to map my own intuition for stops to this adaptive parabolic. I just started off with the conventional. Conventional 0.02, and then tuned that to where I was placing my stop so that I could offload some of that intuition to to math. And so if I'm trading this one and my initial stop is down here at the red line, well, you can see that the PSAR is too far away. Oops, so I need to start tightening that up a little bit. That one feels a little better. That one feels pretty good. You know, I actually like that. I may have to look at changing up my little schedule on that, because I've been using 0.2 and 0.2. I'm actually not opposed to this at all. So you can see one way to experiment with your indicators is to tune them to the behavior that you're trying to replicate. So if you're a discretionary trader with mechanical tendencies like I am, I trust my intuition, and then when I get the feel of it right, I want to be able to standardize that, and so I try to find an indicator that gives me what it is that I want. And I want something that gives me a stop that maybe is not as tight as the southern skin of the dragon, but not as loose as the Bollinger Band mean. And so this actually feels like a nice curve for my stop. That's pretty close to the edge of the dragon, but there are certain moments when that changes. So I may be experimenting with this, but what I use for right now is 0.2 and 0.2. And I don't mind that at all either. One of the things I do like is that if we had done a Z2 trade and then we're able to buy here or at the Bollinger Band mean, and then had this sharp move off the bottom from here, I don't mind having my stop even that close to lock in all the gains on the south side of the river, so that accelerates pretty quickly. And this, I have noticed that on this setting of 0.2 and 0.2, that by the second dot, when the trend shifts, I need to be thinking about reversing. So if I'm short on this one, like I should be, by the time price gets to here, the steepest down almost to Z-3, and then 2 days of improvement and 1 day of holding. By this date, I should be thinking about framing that trade this way, or ready to even to execute on that side. So this current setting of 0.2 is useful. This is just a nice way for you to turn your intuitions or your standard practice into pseudocode that somebody else can execute or that a robot can execute. Then you reduce your risk because it's not how you feel that particular day. It's supplemented or maybe led by a math computation. And I actually don't mind, like on this one, we've got this trade, it comes to here. I don't mind a really tight stop after 4 days of sideways, after a nice climb. I don't mind that a stop right there at all because I know how to re-enter. So even if I do get out here, I can get back in here. So the last thing we want to put on this is the volume at price. We're going to show that on the left hand side, and now you can see how much volume is transacted at each of the price levels, and it gives you a histogram like the market profile, and that tells you where the real decisive action is occurring. So some of that was selling, the red was probably selling in here, and then all this green volume is being bought in here. Now, even though this is about the Bollinger Band, I do want to talk a little bit just about the smooth price so we can get the RLXD discussed. So we're going to add the moving linear regression to price. As you recall, we colored that blue, and it's thick, and it's a 10. And there's a couple moments in here that I really like. I love this entry right in this region. Because we have a double bottom in price, see the 10. We have a double bottom in the Dragon Southern Hump. I want you to notice, we put that stop right there, that his lower hump, southern skin, is actually improved a little amount. So we have this perceptible lazy W in the Dragon on one side of the river, and now we have the 10 period crossing the Dragon the second time. This is not a bad effort, but this one's better because you have this this lazy W. This is a pattern 4 in the regression line crossover system. And now if we add the 30 to this, let's see, moving linear regression. Standard color code of black and thick. Now, the reason this second entry is really good is because you have the initial regression line crossover here, and there's an actual trade in here. But now, this first pulse over and then up again, you have the regression line crossing the Dragon the second time. The 30 has gone from down to flat to up. It's crossed the Bollinger Band mean, so when the 30 regression line crosses the Bollinger Band mean, that's always a good sign. That means this run is officially done. And now we can get any kind of entry we want in here. That's fine. With a stop here below the hump of the Dragon. That could either be here or here. And then you get to participate in all of this. So that's the Bollinger Band framework. Z0. Let's come out here to the. So that's Z0, Z plus 1, Z plus 2, Z plus 3, minus 1, minus 2, minus 3. So let's hold that thought. Let's make this one the 0 line. We're going to make him blue, kind of like colored neutral. All right, so all I've done here is taken a screenshot and snag it, and we're going to just do a quick markup, show you how easy snag it is to use. So there's the edge of the Bollinger Band mean. That's Z plus 1, Z plus 2, Z plus 3. Z minus 1, Z minus 2, and Z minus 3. So really what I'd like you to think about is that each one of these is a vertical slice of that time, and the lines are simply connecting the dots between these measured distances away from the mean. And this sets up like a little health check or a little thermometer ladder, if you will. And so we can make our living from Z minus 2 to Z plus 2 by finding those turning points at Z minus 2 and trading them till they get to Z plus 2. And then on nice trending moves, it's not unusual to see price stay in that channel 10, 15, 20 bars between Z1 and Z2, and on the downside, Z1 and Z2. That's where we make the money. That's where the trends develop, is in that alluvial floodplain. So that's a quick look at the Bollinger Band River framework, and it allows us to understand normal and deviations from the norm. So that's going to be normal and normal is in the river. Deviations from the normal are outside the river and all the way out to Z plus or minus 3. We want to be able to adapt our understanding with disciplined math. So the statistics are calculated and computed, and that allows us to be adaptive, going from a period of reduced volatility, the Bollinger Band pinch, to the expanding volatility, and then the adaptation is driven by math, but the interpretation of what price means inside each of these regions is standardized. To see at a glance how the current price action is adapting to volatility. It was expanding, then contracting, and now expanding. And favorable volatility here to the upside. Finding critical states, that's places where the 30 gets sideways and starts to roll up, where the 10 period and the 30 period conduct a cross outside of the river. That's the essence of the RLCO system. When the RL10 crosses through the dragon, that's always an interesting moment. So if you could buy this, stop here when it crosses once more, and then buy this again and wait for it. As long as that's on the far side of the dragon, you're good to go and you're hooked into the trend. So when the RL10 crosses the 10 period Bollinger Band dragon, especially outside of the river, that's crucial. And then critical states like the dragon being outside of the river and swimming from one side to the other, and then just marching right along the edge of the river. To recognize the potential and implied moves within price location and volatility structure. So a price that has diverted from the mean and moved all the way down to Z minus 3 has an implied move back to the mean. There's our triangle. To see the nudge that gets it all started, the big spike down, the recovery, the RL10 changing, crossing the 30, crossing the dragon, crossing the mean, leaving the river. When price and the 10 and the 30 period regression line all leave the river, that's right here. That's the beginning of trending behavior. That location right there is the beginning of trending behavior. Whenever price and the 10 and the 30 are inside the river, that's the chop. You have to wait for it to clear the river. You get eaten up by crocodiles on this red line. And then if price gets past a Z3 in either direction, that's an extraordinary event. Something huge just happened. And a snap back to the mean is not surprising, and a runaway move in a new direction is not surprising. All the rules are off when you get outside of those red boundaries. That tells us the difference between normal and true abnormal. And so in the end, what we have with this is an adaptive, disciplined, flexible, consistent, a structure and a scaffolding that allows us to frame trades and make decisions using current measures of volatility as defined by recent price action over a statistically significant look-back period. And this works on every time frame. So, thanks for your kind attention. It's Ken Long from Tortoise Capital with part 2 of the Bollinger Band Mean explanation.